everyone, I am Angel Joyce Evangelista, your presenter for today. And today's topic is about instruments of monetary policy. So here are the learning objectives wherein at the end of the discussion, you should be able to define monetary policy and explain the objectives of monetary policy. Enumerate and explain the instruments of monetary policy. But before I proceed to our discussion, I prepared some refreshment activity entitled Crack the Instruments. So there are letters flashed on your screen, and what you have to do is decode the hidden words out of these letters. So the hint here is you're going to look back on the letters before it in the alphabet. So I will show also some example for you to easily crack the instruments. Crack the words, rather. So, did you get all the correct words? Well, that's great because all the words that you have decoded are related to our topic for today. So, let's now start our discussion. So, let's define first what monetary policy is. Monetary policy refers to the credit control measures adopted by the central bank of a country. It also manages the size and growth rate of money supply of an economy. So it is also a powerful tool which regulates macroeconomic variables such as inflation and unemployment. It is the policy employing central banks' control of the supply of the money as an instrument for achieving general economic policy. Now proceed to the objectives of monetary policy. So as you can see on your screen, I provided four objectives of monetary policy. The first one is economic growth, full employment, price stability, and exchange rate stability. So let us discuss it one by one. Monetary policy promotes sustained and continuous economic growth by maintaining equilibrium between the total demand for money and total production capacity and creating favorable conditions for saving and investment. A government tries to achieve economic development wherein there will be proper utilization of natural and human resources, more capital, more employment, increase in national per capita income, and increase in standard living. So, economic growth is necessary to increase production and demand. It can also target inflation levels. So, a low level of inflation is healthy to the economy, which could boost the economic growth. Another objective of monetary policy is the full employment. This policy serves as an effective and ideal stimulant to private investment as there is pessimism in the economy. This policy should be followed to promote full employment through increasing in investment. After achieving this objective, the policy should also aim at exchange rate and price stability. So the next objective is the price stability. So, monetary policy promotes business activity and ensures equitable distribution of income and wealth. It increases in the price level that provides a tonic for economic growth. Stable prices improves public confidence, promote business activity, and ensure equal distribution of income and wealth. Monetary policy, having an objective of price stability, tries to keep the value of money stable. It also helps in reducing the income and wealth inequalities. So the last objective of monetary policy is the exchange rate stability. So the monetary policy aims at maintaining the relative stability in the exchange rate. So this system will correct the equilibrium in the balance of payments and exchange stability will be maintained. It regulates the exchange rates between domestic and foreign currencies. So after discussing the objectives of monetary policy, so by implementing effective monetary policy, according to Fed, it can maintain stable prices which will support conditions for long-term economic growth and maximum employment. Let us now enumerate the instruments of monetary policy. So the instruments of monetary policy is divided into two, the quantitative instruments and qualitative instruments. So quantitative instruments are also known as general tools used by the Reserve Banks of India. So these instruments are related to the quantity and volume of the money and designed to control the total money of the bank credit in the economy. So under the quantitative instruments, we have bank rate, legal reserve ratios, open market operations, repo rate, and reverse repo rate. On the other hand, we have the qualitative instruments. So these qualitative instruments are also known as selective instruments. So this is used for comparing various uses of credit or export or import, essential or non-essential credit supply. It also influences on both borrowers and lenders. So under qualitative instruments is the rationing of credit, regulation of consumer credit, change in marginal requirement, and moral suasion. And let us discuss it one by one. So let us start with the quantitative instruments. The first quantitative instrument is the bank rate, or also known as discount rate. So the interest rate charged by Federal Reserve banks to depository institutions on short-term loan. So the central bank lends money and rediscount bills of exchange and securities held by commercial banks. The Fed may increase or decrease the discount rate to slow down or stimulate the economy respectively. The lower bank rates can help to expand the economy by lowering the cost of funds for borrowers, and higher bank rates help to rein in the economy when inflation is higher than desired. The next quantitative instrument is the legal reserve ratios. So commercial banks have to keep a certain amount of reserve assets in the form of cash reserves in order to maintain liquidity and control credit in the economy. So it manipulates by the Fed in order to influence the ability of commercial banks to lend. The next instrument is the open market operations, the sale and purchase of security in the long or short run in the money market. So it involves the buying and selling of government securities. So the Fed's most important day-to-day instrument is the open market operation for influencing the money supply. So it is flexible and most used tool of monetary policy. So when we say open market, it means that the Fed doesn't decide on its own, but it emerges from an open market wherein the security dealers that the Fed does business with, the primary dealers, compete on the basis of price. The next instrument is the repo rate at which commercial banks borrow money by selling their securities to the Reserve Bank of India to maintain liquidity. So here, commercial banks sells their securities in case there's a shortage of funds or due to some statutory measures. So it main instruments to keep inflation under control. On the other hand, we also have the reverse repo rate. So the Reserve Bank of India borrows money from commercial banks where there is excess liquidity in the market. So here, kapag mataas ang inflation sa bansa, pinapataas ng Reserve Bank of India ang reverse repo rate na naghihikayat sa mga bangko na ilagay ang mas maraming pondo dito na makakatulong na makakuha ng mas mataas na pagbalik ng labis sa pondo. So let's now move on discussing the qualitative instruments. So the first qualitative instrument is the rationing of credit. So it is the method of controlling and regulating the purpose for which credit is granted by commercial banks. So it aims to limit the total amount of loans and advances granted by commercial banks. So credit is given by limiting the amount available for each commercial bank. So this helps in lowering the bank's credit exposure to unwanted sectors. So this instrument control the bill with discounting. The next instrument is the regulation of consumer credit, wherein consumers' credit supply is regulated through the installment of sale and hire purchase of consumer goods. So here, the installment amount, down payment are all fixed in advance, which helps to check the credit and inflation in the country. The next instrument is the change in marginal requirement. It is used to encourage the credit supply for the necessary sectors and avoid it for the unnecessary sectors. So the change in marginal can lead to change in the loan size. It can be done by increasing the marginal of unnecessary sectors and reducing the marginal of other needy sectors. The last instrument under qualitative is the moral suasion. So, in moral suasion, suggestions to commercial banks from the RBI that helps in restraining credits in the inflationary period. So, when we say moral suasion, it means persuasion and request. So, it is to arrest inflationary situation. Central bank persuades and requests the commercial banks to refrain from giving loans for speculative and non-essential purposes. So we are done discussing the quantitative and the qualitative instruments of monetary policy. So the implementation of these instruments plays an important role in the development of the country. So if the required money supply for the economy is not available in the market, it leads to a decline in investment in the economy. On the other hand, if the money supply in the economy is more than what is required, then the poor section of the economy will suffer because the price of essential commodities will rise. So, all in all, monetary policy aims to accelerate growth and stability by controlling the credit supply in the economy, effective and efficient to control inflation and deflation due to the movement of the economy supply in the economy. So that's all for today. I hope you learned the different instruments of monetary policy. Thank you, God bless, and keep safe.